Welcome to the deep dive. Navigating the world of finance and geopolitics today, it can feel like trying to catch smoke. It's constantly shifting incredibly fast
Uh-huh.
and full of these hidden currents. Keeping up with the headlines, market swings, political statements, it honestly feels like a full-time job sometimes.
It really does. The speed is just relentless.
Exactly. So our mission on this deep dive is really to cut through all that noise, give you a sharp shortcut to being truly well-informed. We've meticulously combed through a stack of sources, pulling out the vital nuggets of knowledge and maybe some surprising insights.
Right.
This is your clearest picture yet of what's really shaping the markets and, the world around us.
And today, we're going to try and connect some dots that might seem pretty disparate at first glance. We'll explore the immediate and I think surprising impact of escalating global tensions on bond markets.
Okay.
Then we'll dive into the complex dilemmas facing major central banks right now, specifically the European Central Bank, the ECB, and the U.S. Federal Reserve.
Always interesting.
Definitely. And finally, we'll look at a uniquely bullish perspective on the U.S. market. It's one that challenges some of the, let's say, gloomier forecasts out there, revealing threads you might not have seen before. Our sources, they range from top financial news outlets to some pretty in-depth economic analyses, so we've got a good comprehensive view.
Okay, let's unpack this then, maybe with some Monday morning clarity if we can manage it. We're seeing headlines about a global bond sell-off, and Europe, kind of strangely, seems to be right at the epicenter. What's the immediate spark? What lit this particular fuse?
Yeah, the spark, it seems pretty clear. There's a sharp escalation of conflict in the Middle East, specifically involving Israel and Iran.
Right.
And these tensions, they instantly ignited concerns over possible oil supply disruptions. Just the fear alone was enough to drive Brent crude sharply higher. It got close to $75 per barrel almost immediately.
75, wow.
Yeah, and that move, it just triggered fresh inflation anxieties. This is especially impactful for energy importing regions like Europe because they're particularly vulnerable to oil price shocks.
Okay, so you've got that immediate fear, that spike in oil. How did the bond market specifically show the strain? Was it like a broad brush reaction, or did certain types of debt get hit harder?
Oh, it was a very telling reaction. Yields on European government bonds, they jumped, which means their prices plummeted, right?
Right, inverse relationship.
Exactly. Investors were quickly dumping sovereign debt. That really made Europe the epicenter, as you said. Now, U.S. Treasuries, they followed suit, but their move was, let's say, more modest. Still notable, though. And it just highlights the truly global and interconnected nature of this sell-off. What's really insightful here, I think, is the hyperconnectivity of markets today. Unlike decades past, even just the potential for an oil supply disruption.
Yeah, just the whiff of it.
Exactly. Given global energy dependencies and, frankly, algorithmic trading, it can trigger this flash reaction across bond markets. It's a stark reminder of just how thin that line is between distant geopolitics and, well, your daily cost of living.
That's a really good point.
And this also fueled a broader risk-off tone in the markets. Investors pulling back from riskier assets like equities, looking for safer havens, even if those havens were just relatively less exposed bonds.
Okay.
So bond prices declined. Like we said, yields spiked. And a yield spike basically means the interest rate and investor demands to hold the debt has gone up. It signals increased perceived risk or maybe inflation expectations.
Got it.
And we saw increased equity market volatility tied directly to these geopolitical worries. What's fascinating, though, is that some investors even began rotating into bonds from places with perceived better inflation prospects, like New Zealand,
Oh, interesting.
while actively selling off European and U.S. long-dated debt. So that tells you investors aren't just reacting blindly, they're actively seeking out havens based on where they think inflation is headed.
So for you, the learner listening in, what's the core takeaway here about these global ripple effects? This isn't just abstract financial jargon, is it?
No, exactly right. This isn't just about abstract market movements or numbers flickering on a screen. It highlights how quickly geopolitical events, even potential ones, can translate into very real-world economic pressures. And these pressures, they influence everything from the inflation rates you feel at the pump to the investment strategies that professionals and individuals, too, need to consider for their long-term savings. It's just a vivid demonstration of how interconnected the global financial system has become.
Right. So, okay, if geopolitical tremors are shaking bond markets globally, what about the institutions that are meant to steady the ship? The central banks. It seems like both the European Central Bank and the U.S. Fed are facing their own unique Pretty complex dilemmas right now.
They certainly are, and it really feels like they're walking a tightrope.
Mhm.
Let's maybe start with the European Central Bank, the ECB. Their predicament is particularly tough. They're caught between these energy-driven inflation risks from the oil price spikes we just talked about
Yeah.
and surprisingly sluggish economic growth. I mean, their GDP, it's projected around a modest 0.9% in 2025. That's not exactly roaring growth.
Not at all.
So the ECB outlined 3 potential policy scenarios back in June. One was a sort of mild growth scenario allowing for rate cuts, then a baseline of just steady policy, and then a severe scenario forcing tighter policy because of more shocks.
Okay.
What's a bit concerning is that markets seem to be assuming the most benign, mild scenario, and that could be a potentially risky gamble if global events don't play out exactly as hoped.
Right, banking on the best case. And over in the U.S., the Federal Reserve, the Fed, they seem to be under a different kind of pressure, a much more public one, perhaps.
Indeed. We've seen former President Donald Trump's renewed and quite vocal public criticism of the Federal Reserve and its chair, Jerome Powell.
Yeah, that's been hard to miss.
Right. He's been very specific in his demands, calling for, I think the quote was, a total of 10 rate cuts for growth and winning. And he's publicly labeled Powell clueless, unfavorably comparing him to some foreign central bankers. So this puts the Fed in a truly unique policy dilemma. They're currently in a holding pattern, right?
Yeah.
Carefully assessing inflation, which, okay, it's cooled to around 2.5% from its peaks, but it's not yet at their 2% target.
It's still sticky.
Exactly.
Yeah.
And they also have to deal with strong wage growth, which could keep inflation sticky, and an economy that, while it's not showing immediate signs of recession, is seeing slowing corporate investment.
Yeah.
So they have to balance multiple, sometimes conflicting data points. It's tricky.
The Fed is famously and, rightfully meant to be independent and apolitical. But given how markets reacted to Trump's comments, isn't it fair to say some influence has already been exerted, even if subtly, just by virtue of the public scrutiny? How does this political pressure specifically complicate the Fed's strategy?
That's a really insightful observation, because while the Fed is meant to remain independent, Trump's repeated politicization of rate policy forces Chair Powell into this, well, delicate dance.
Yeah.
He has to weigh the perception of independence against the actual economic data and market expectations against the potential optics of political influence. Economists widely warn that yielding to political pressure, even subtly, could undermine the Fed's crucial credibility and investor trust in U.S. institutions.
Which is huge.
Absolutely. That's a far more damaging long-term impact than any single short-term rate decision. Powell himself has publicly stressed repeatedly that the Fed remains data-driven. Although interestingly, in recent FOMC minutes, he did admit that external pressures are elevated, a clear nod to these political headwinds without, directly naming Trump, of course.
Right, careful wording.
Very careful. Now, in terms of market reactions, bond markets have become noticeably more volatile. Traders are now trying to interpret not just the economic indicators, but also this political influence. Futures pricing, basically what traders are betting on for future interest rates, is already reflecting increased odds of a rate cut, despite there being no strong macroeconomic data that would singularly warrant such a move right now.
So the noise is getting priced in.
That's exactly it. Political noise is now a factor in market pricing, which is a worrying development, frankly.
So for you, the astute observer trying to read the central bank tea leaves, what's the key implication of these dual pressures, the economic data and the political influence?
Well, I think it just means higher uncertainty in both bond and equity markets. The Fed is probably less likely to cut quickly, despite Trump's public pressure, precisely because they must guard their independence and credibility.
Right, reacting looks bad.
Exactly. And furthermore, if Trump wins in 2024, his influence over the Fed could expand. If political interference were to become normalized, it could make future monetary policy less objective, more unpredictable, which is really not what markets or the economy needs for stability.
Okay. Now let's pivot a bit from these worries and dilemmas to, well, a surprisingly optimistic view. Despite everything we've just discussed, the geopolitical uncertainty, the central bank tightropes, one expert, Yardeni, sees the U.S. bull market roaring ahead. What's his core, almost counterintuitive thesis here?
Yeah, Yardeni's perspective is truly fascinating because it hinges on the market's unexpected reaction to a very significant event. The U.S. airstrike on Iranian nuclear facilities, Fordo, Natanz, Esfahan, using those formidable GBU-57 MOP bunker busters.
Right, those massive bombs.
Massive precision-guided bombs designed to penetrate hardened targets. What was striking was how little the markets flinched. Oil actually fell, gold softened, and equity futures climbed.
That seems backwards.
It does. Yardeni interprets this as geopolitical fatigue. Basically, investors simply don't expect a wider, prolonged war. They're suggesting Iran might not retaliate aggressively. Now, that's a bold claim, absolutely.
That is a powerful interpretation, especially the idea of geopolitical fatigue. But couldn't that fatigue also be interpreted as maybe complacency? Perhaps underestimating the true tail risks of these tensions. And he has this fascinating Tel Aviv signal, right? It feels almost counterintuitive to look for bullish signs from the heart of a conflict zone.
It's a fair challenge, absolutely. Is it fatigue or complacency? Yardeni would argue that his Tel Aviv signal provides the evidence against mere complacency. He sees the MSCI Israel Index that tracks the Tel Aviv Stock Exchange hitting record highs even after the strike.
After the strike.
Yeah. He sees that as a rare and incredibly powerful global bullish signal. His interpretation is that Israeli investors, the ones closest to the conflict who have the most at stake, clearly don't expect the war to escalate significantly. This implies confidence in long-term peace, possibly due to Israel's perceived military dominance and strong U.S. backing. And has that kind of localized, in-the-know signal proven accurate in past geopolitical flare-ups? Often, yes. Those closest to the situation, their collective action can be a pretty strong indicator.
Okay, that context helps.
And he even expands on this with the potential for a major diplomatic breakthrough through the expanding Abraham Accords. This is his really bullish scenario. It suggests that if Iran de-escalates, or maybe its regime shifts, and crucially, if Saudi Arabia were to join the Accords—
that would be huge.
Huge. It would create this powerful Israel-Arab bloc. This would further isolate Iran, stabilize critical oil routes, and lead to significantly lower risk premiums across the region, more capital inflows, fewer global oil shocks. It's quite a grand vision of regional stability.
So if the Middle East is seen as potentially stabilizing, at least through this lens, what does that mean for the U.S. stock market specifically? And Yardeni's whole roaring 2020s thesis, what powers that kind of long-term optimism?
Well, connecting this to the bigger picture, Yardeni firmly believes that the S&P 500 bull market, the one that began back in October 2022, is still very much intact, despite all the global noise.
Right.
He sees it powered by a potent combination of factors.
Right.
You've got consistent earnings upgrades from companies, the relentless ongoing AI and innovation cycle driving productivity.
Which we see everywhere.
Everywhere. Surprisingly resilient consumer spending, still holding up. And a renewed wave of corporate M&A, mergers and acquisitions, and automation. This, he argues, is the engine of the next economic boom.
So he's really looking past the immediate headwinds.
Very much so. He even has incredibly specific and, frankly, ambitious S&P 500 forecasts. A range of 6,000, 6,500 by the end of 2025.
Okay.
And an eye-popping 10,000 by 2030.
10,000, wow.
Yeah. He believes this will be driven by continued tech leadership and what he calls his roaring 2020s thesis, echoing the post-pandemic boom of the 1920s. He sees potential for broad-based growth, not just tech, as automation and AI really permeate all industries.
And there's data to back this up somewhat.
Well, to support this, S&P forward earnings estimates have actually hit record highs for 3 consecutive weeks.
That's significant.
It is. It shows companies are navigating tariffs, supply chains, maybe better than expected. We've also seen concrete examples like Tesla's robotaxi rollout in Austin. That's a big bet on the future. And Bank of New York Mellon approaching Northern Trust for a merger. He interprets these as clear signals of confidence, a welcome return of those animal spirits to the market that sort of renewed, almost irrational exuberance and willingness to invest that really drives strong bull runs.
So why should you, the learner listening, pay attention to this optimistic counter-narrative, especially when it feels so different from the daily headlines we're bombarded with?
Because it offers a crucial, different perspective amidst all the global uncertainties. Despite the geopolitical tensions, the central bank dilemmas we just discussed, these specific signals suggest underlying strength and, potentially, significant growth ahead. It's a powerful reminder that markets often price in future events in ways that can be really counterintuitive in the short term, and that looking for these unique signals, like the Tel Aviv Index, can provide valuable insight that maybe cuts through some of the noise. It challenges you to consider if the prevailing narrative is truly capturing the full picture.
What a deep dive this has been. We've really explored this fascinating tension in the global landscape, haven't we? A world teetering on geopolitical uncertainty and these complex central bank dilemmas,
Yeah,
yet simultaneously showing remarkable resilience and these surprisingly bullish signals in specific areas of the market. It's a true Monday morning wake-up call for how these forces interplay.
definitely. We've seen how specific geopolitical incidents can immediately reshape bond markets. We talked about the delicate tightrope central banks are walking, managing inflation, fostering growth, navigating political pressure.
Right.
And then there are those surprising bullish indicators, like that Tel Aviv signal, suggesting a deeper, perhaps more informed confidence in the long-term outlook for certain markets. It forces us to ask,
Yeah.
are we overreacting to the daily headlines, or are we maybe missing the larger, more powerful undercurrents?
So as you process all of this, what stands out to you? How much weight do you put on unique localized market signals like the Tel Aviv index versus the political noise and central bank statements we hear every single day?
That's the key question.
And in these incredibly complex times, is geopolitical fatigue a valid investment strategy that accounts for the inherent risks, or is it actually a dangerous gamble that ignores potential future shocks? Something to think about.
Definitely food for thought.
Thank you for joining us on this deep dive. We encourage you to keep exploring these topics, keep questioning the narratives out there, and, keep digging for those crucial insights. Until next time.